The last recording I want to make for this chapter starts with page 119 in your book, and this discusses the standard deduction. All right, this may be the last year that most people will be able to itemize, as starting in 2018 with the new tax law, the standard deduction has doubled for all the amounts that you see on page 119, and then it'll also be indexed for inflation. So basically what it is a lot of times you hear people say that they filed long form, and the form they're referring to is Form 1040. Okay, now if you're going to go into business for yourself, or if you're going to work somewhere, I would recommend that you file all tax returns on Form 1040. Now, Chapter 1 discusses, Form 1040EZ and Form 1040A, which are the smaller forms that certain people, especially single people with just, wage income, can file. All right, they are easier to do. But the problem with that is that you have to learn three different forms. If you just, the 1040 is the default. The 1040EZ and the 1040A are the exceptions. So you can put anybody on a 1040. It doesn't matter who they are. All right, so that would be the form that I would use, honestly, for all your returns, and whether or not you're going to do them, for your homework or do them in real life. Okay, so what you want to do is you want to ascertain, first of all, whether or not your client can itemize. Now, itemized deductions is discussed in Chapter 5, but basically what it means is that the client is going to claim their medical expenses. They're going to claim the state and local income taxes that they, paid out of their paychecks. They're going to claim their real estate taxes and the excise taxes on their vehicles and their mortgage interest and charitable contributions, casualty losses, and miscellaneous deductions. Okay, in order for a taxpayer or taxpayers to itemize, they have to be able to add up their deductions and beat the amounts that you see on page 119. Now, there are some caveats to this, all right? For example, for most people under the age of 65, the first 10% of their out-of-pocket medical expenses can't be deducted. So, it's 10%. When I mean by that, it's 10% of their adjusted gross income. So let's say, for example, that somebody has $40,000 in AGI. All right, so, and most of the amounts that we're going to be talking about are going to be based on AGI. All right, if you remember, AGI can be found at the bottom of the first page of the 1040 or the top of the second page of the 1040 on lines 37 and 38. All right, so again, for example, if a client comes in and they made $40,000 of AGI, all right, that means generally that the first $4,000 of medical expenses can't be deducted. All right, so if their medical expenses are less than that, all right, then they would not be able to deduct any medical expenses, and their itemized deductions start off with an amount of 0. All right, so what I have done over the years is, if a client is close, all right, once you get good at it, you can fill out a Schedule A in a matter of minutes if you have all the data, and you're going to know very quickly whether or not your client can itemize or not. Now, obviously, if they're single and they only have to beat a standard deduction of $6,350, it's easier for them to itemize than if they are married filing a joint return and have to beat a standard deduction of $12,700. Okay, Again, one of the few advantages of married filing a separate return is that the standard deduction amount is the same as a single person. So if you're filing married, filing separate, you only have to come up with $6,350 of itemized deductions in order to be able to itemize. All right, so the bottom line is you're going to take the larger of the two on line 40 of Form 1040. Okay, line 40, which is on page 2. All right, you either take the itemized deductions, which are found on Schedule A, or you take the standard deduction, whichever is larger. And again, for 2018, the standard deduction is going to be almost doubled, not quite, for all taxpayers. All right, and will be and before you go, yay, that's really great, keep also in mind that the exemptions are going to be eliminated. Okay, all right, they are trying to simplify the return a little bit, but they may not necessarily mean that your refund is going to go any higher. Okay, all right. If you are over the age of 65, and again, your age is determined by what your age is on December 31st. So if the client, if the taxpayer or the spouse is age 65 or over on December 31st, 2017, then they get an additional standard deduction of $1,550 if they are unmarried, and $1,250 if they were married or a qualifying widow or widower. All right, again, the tax software will do this for you. All right, assuming that you fill the software out properly. Okay. All right, there are some people who are not eligible, all right, for the standard deduction. All right, it mentions that on page 120. All right, if you are married filing separate and your spouse itemizes, then you must also itemize no matter what the amount is, and that amount could very easily be less than your standard deduction. Okay. All right, there are also some limitations for dependents. Okay, and this gets kind of funny, especially when the dependent has a job, or worse, when the dependent has what we call unearned income, where they're getting like dividends and interest on an investment that was set up for them, maybe when they were babies. All right, it's rare, but you do see that once in a while. Okay. The chapter ends with an overview of capital gains and losses. That will be the subject of Chapter 8 in its entirety. The one thing you only need to remember at this point is that capital losses are limited to $3,000. So if you were to go to the first page of the 1040 and you look at line 13, the smallest number that you would ever see on line 13 is minus $3,000 for a capital loss. Okay, all right, that we are coming very close to the end of this video. All right, and I think that will end it.